But real bubbles start quietly. Inside reasonable decisions, inside good intentions, inside systems trying to heal. If you want to understand how bubbles really form, stop staring at the peak. Start watching the plumbing. Every bubble begins with a real wound, a recession that will not end, a crash that breaks trust, a war that scrambles supply, a productivity slump that makes growth feel impossible. Something forces leaders to choose between pain now or risk later. So, they act. Rates come down, liquidity arrives, backstops appear. At first, this is not recklessness. It is triage. Markets stabilize, credit reopens, people breathe again, and that relief becomes the first ingredient. The belief that the system can always be steadied. When intervention works, it teaches everyone a lesson. Banks learn that funding can be supported. Investors learn that drawdowns can be softened. Politicians learn that panic can be postponed. The public learns to stop watching. Nobody calls it a bubble. They call it stability. But stability can become a habit, and habits change behavior without anyone noticing. Risk does not vanish. It becomes easier to carry. Leverage does not look dangerous. It looks efficient. Complexity does not look suspicious. It looks sophisticated. Low interest rates do not create bubbles by themselves. They create the conditions where bubbles can live. Cheap money is oxygen. It only becomes a problem when something starts burning. The first thing that burns is return. Safe assets stop paying. Savings stop compounding. Pensions and insurers realize they cannot meet promises with yesterday's tools. So, capital searches, not in a single leap, but in small, defensible steps. A little more credit, a little more duration, a little more leverage, a little less liquidity. Each step is justified by a spreadsheet. Each step is blessed by a committee. That is why bubbles are hard to spot. They are built by professionals, doing exactly what they are paid to do. When the safest returns fall to zero, risk migrates. First, it moves from government bonds into corporate credit, then into lower-rated credit, then into structured products that claim to be safer than they are, then into assets whose value depends on perfect conditions: real estate, venture capital, speculative technology, commodities, crypto. This is not greed, it is survival under a new math. If your mandate demands 7% and the risk-free rate gives you 1, you have only 2 options. Admit the model is broken or take more risk. Most institutions choose the second because the first is career suicide. So risk moves outward, step by step, until the entire system is leaning on assumptions. Once demand for yield is everywhere, finance supplies it. New instruments appear, and they often start as genuine solutions. Securitization spreads risk. Derivatives hedge exposures. Structured products promise stability through diversification. But there is a catch. Repackaging risk makes it harder to see, harder to price, easier to underestimate. Complexity turns uncertainty into a number that looks precise. Ratings turn unknowns into letters that look safe. And because these tools work during calm periods, they become trusted. This is the moment the bubble stops looking like a bubble. It starts looking like engineering. Leverage rarely arrives with fireworks. It arrives as optimization, a small margin facility, a repo line, a total return swap. At first, leverage is optional. Then it becomes strategic. Then it becomes necessary. Because once competitors use leverage, their returns look better, their volatility looks smoother, and their investors look happier. So everyone adopts it to keep up. Not because they are reckless, but because they are measured against the wrong yardstick. Leverage amplifies outcomes, but more importantly, it amplifies belief. Belief that volatility is controlled, belief that exits exist, belief that risk is understood. Now, prices begin to rise, not explosively, gradually. This is the most convincing lie in finance, because it feels earned. Slow price increases validate models, they reduce measured risk, they justify leverage. Rising prices become proof. Proof that the system is stable, proof that innovation works, proof that skeptics are wrong. This is the calmest phase of every bubble and the most dangerous. People think narratives create bubbles. Most of the time, narratives arrive after the gains. First, the chart goes up, then the story appears. This time is different. Technology changed everything. Institutional adoption, structural demand. These stories are not lies. They are selective truths, stretched into prophecy. They explain yesterday and promise tomorrow. Once the story settles, doubt turns into social risk. Skeptics are not debated, they are dismissed. Not because they are wrong, but because the system cannot afford them to be right. Risk is usually measured using the past, but bubbles change the structure of markets. Correlations rise, liquidity thins, crowded trades become dangerous. Yet historical models keep reading calm as safety. Measured risk declines. Actual fragility increases. That is why bubbles feel safe. Right before they break. The dashboard looks fine. The engine is overheating. There is no single alarm that says bubble. But there are patterns. Leverage rises faster than income. Complexity rises because simple assets no longer work. Caution is punished more than risk. Volatility falls while positioning becomes crowded. And survival becomes dependent on friendly policy. When markets price protection instead of risk, fragility is already baked in. People assume professionals exit early. Sometimes they try. But professionals are constrained. They have mandates, benchmarks, quarterly reporting. They cannot sit in cash forever, so they stay longer than they want to. Hedging, rationalizing, hoping the cycle extends. When they finally move, they move together. That is when smart money becomes the same crowd, just with better vocabulary. Liquidity is not permanent. Liquidity is a promise that depends on conditions. In calm times, buyers exist. Spreads are tight. In stress, buyers step back. Spreads widen. When everyone wants to sell at once, there is no market price. There are only bids that disappear. Now, add leverage. Small price moves trigger margin calls. Margin calls trigger forced selling. Forced selling pushes prices lower. The exit door becomes a bottleneck. This is when people learn the truth. Liquidity was conditional, and the condition was faith. During bubbles, almost everyone believes they will exit in time. They have stop losses, hedges, discipline. Exits fail not because people are lazy. They fail because exits are shared. When everyone rushes the same door, individual plans collapse. Every bubble has a trigger, a rate hike, a default, a policy shift, a headline. But the trigger does not cause the collapse. It reveals it. If the system were resilient, the trigger would be absorbed. The reason it is not absorbed is simple. There is no room left to bend. Diversification stops working. Assets move together. Credit falls with equities. Real estate weakens with tech. Forced selling does not care about your thesis. It cares about your margin. The collapse usually begins quietly. Funding rolls hesitate. Trades slow. Spreads widen. Phones start ringing, not publicly, privately. This is when insiders realize the truth. The system is no longer stable, it is brittle. When authorities intervene, it looks like the problem is solved. Liquidity injections stop the bleeding. Backstops reopen markets, but they do not restore trust. They buy time, and time is not a cure. A bubble is not high prices. A bubble is a system that requires confidence to function. When belief replaces resilience, collapse becomes inevitable. Not because people panic, but because the structure cannot survive doubt. After every collapse, people say the signs were obvious. But during formation, bubbles feel like progress, they feel like rescue, they feel like adaptation. Each rescue teaches the system the wrong lesson. That stability can be engineered forever. So the next cycle begins with more debt, more complexity, and more faith. That is why bubbles return, not because humans never learn, but because systems reward forgetting. So don't ask, are we in a bubble? Ask, what assumptions must stay true for this system to survive? If the answer is many, you are looking at fragility. If the answer is confidence, you are looking at faith. Faith is not collateral. Faith is not cash at 9 a.m. when everyone wants out at the same time. And next, we'll follow the moment faith gets tested. When the system has to prove it can function without the story.